at a high level, walk through the value proposition for adding each of these into a diversified portfolio. Let's start with the defensive bull fund.
Yeah. So at a high level, let's take a step back and just say, all right, we have this composite system, and we have a couple different composites that we use, right? So at a high level, you use this combination of technical indicators to give you the answer of whether you want to be invested in the market or not, right? It's binary, yes or no. And at that point, what you invest in dictates which fund you use, right? So what I mean by that is you get your answer and it says yes. Now, the second question is, okay, fine, you want to be invested in the market. How do we go attack that? And that's how the funds are set up, right? So if you start at the lowest level, the fixed income, the tactical fixed income, CRMVX, the answer is yes, I want to be invested. And then it goes after a universe of high yield funds, emerging market funds, more low volatility plays. And as you go higher up the risk level, then you introduce more investment. The investment universe gets larger, right? So then let's go to CRMVX to tactical rotation, which then introduces still low vol, but a little bit more equity, right? So we're looking at defensive sectors of the market, whether it's UTS or healthcare, in some cases real estate, and it adds that to the mix. Tactical opportunities then takes more opportunities and dives into subsectors of that, right? So you take, let's say, financials at tactical rotation. Well, opportunities will dive in further and say, do we want broker dealers or insurance as subsectors of that? It can take more chances on certain subsectors of larger plays. And then see Potomac Defensive Bull, which is the largest one, is just buying leverage exposure to an index. In most cases, it's the S&P 500. Again, everything keys off this composite system that gives us that binary: do we want to be invested or do we want to be in cash? The decision that at that point is what investment universe you're going to attack.
Okay, so then how should an advisor think about adding these types of strategies to a diversified portfolio? Is there a framework that you recommend?
Yeah, I think it comes back to my earlier point about this bear market and diversification, right? Where I'm a big believer in this barbell approach, where on one side, I think we live in a really great time where you can buy cheap passive funds for 2 to 3 basis points, right? There's nothing wrong with that. You get exposure to the market. It's tax efficient. It's and it's cheap, right? And we know it works. But what do you do when the risk needs to be reduced, right? Because not all of us can tolerate the max drawdown that comes with buying and holding an S&P 500 fund. It's great when younger CFPs are talking to their advisor, to their clients, and telling them all you have to do is own these 3 funds. That's fine and dandy. But as you age, that your risk profile changes. You don't have the time horizon to take on that type of drawdown risk. So what do you do at that point, right? So coming back to our initial talk, do you add bonds? Do you add commodities, gold? What do you add to successfully reduce the risk without necessarily destroying the return? And that's where our funds come in. You have the ability to reduce drawdown, reduce correlation, adding in this diversification, this tactical diversification, but you're not necessarily giving up too much of the return premium, because we have the ability to be invested in equity markets at the right time. Not all the time, but at the right time.